Alright, we're going to have a little refresher on what we did in the Accounting 1 course to connect it with QuickBooks. Journalizing and posting. So here's your journal page. Our transaction is to enter a bill from Brooks Insurance on May 3rd for $164.78. First thing you do is you're going to date it. Then you are going to choose what account will be debited. We are purchasing insurance, so the account to be debited in this case is going to be insurance expense. Then we will debit it for the amount $164.78. Then we need to choose what account is going to be credited. If we are entering this as a bill and this is not being paid right now, we owe it, so that is going to be accounts payable. Additionally, the vendor's individual account would be credited also. So we now owe more money in accounts payable. Now we would go and post to these two individual accounts in the general ledger. The insurance expense account, we would date it, we would put the post reference, which is journal page 1, and we would debit the account. Debiting the account would increase the account because it's an expense and it had no prior balance, so the account balance is now $164.78 in the debit column. Then we go to the accounts payable account, we date it, post reference it. We would credit the account, which is an increase to accounts payable. It had no prior balance, so it has a credit balance of $164.78. We would then go back to the journal page and be sure to put those post references, which are the account numbers that we posted to. Next, we're going to do another transaction. We're going to pay the bill that we received from Brooks Insurance. So we're going to pay it on the 11th, so we put the date. Now, what account should be debited if we are now paying off a debt that we owed? Accounts payable needs to be debited because we need to decrease accounts payable. We will decrease accounts payable by the $164.78. And what account needs to be credited? Well, we are paying, so that's got to be our cash or checking account that's going to be credited for the same amount, $164.78. Note that when accounts payable is debited here, we would also decrease what we owe this vendor in the subsidiary account. And then we would, of course, post and put our post references. Okay, here's what it looks like posted. We go to the accounts payable account. We debit it for $164.78. We calculate a new balance in the account. The new balance would be 0 because we had $164.78 balance and now we are debiting it, which makes it have a 0 balance. We go to the checking account. We have a prior $50,000 debit balance. We are crediting the account for $164.78. So we would subtract, and that would leave us with $49,835.22. The next entry, we're going to enter a sale on account. So this has to do with customers. So when we enter a sale on account, that means we are selling something to a customer and they are not paying us yet. So what account does that affect? That is going to be your accounts receivable. Note that we would also affect the customer's individual account too. So they owe us $94. And this is a service business, so service revenue would be our credited account, and that is increasing our revenue account by $94. Okay, now we would go and post to the accounts that were affected. Accounts receivable, we would debit for $94. And there was no prior balance, so the new balance is debited for $94. Then we would go to our income account, our revenue account, services revenue, and we would credit the services revenue account. There is no prior balance, so we would have a credit balance of $94. Another way of making a sale is a sales receipt. Sales receipts are cash sales. So when we are going to journalize a cash sale, we would date it. And what would be debited for a cash sale? Well, usually it's going to be cash or checking. Now in QuickBooks, this is something to note, there is an account called undeposited funds, and money received from sales goes into this account before going into the checking account, which you'll see in a later video about deposits. But for journalizing purposes, we will journalize to cash or checking. We are going to debit it for $35, a made-up amount, and then we would credit our services revenue account for $35. So that's how you would journalize a cash sale or sales receipt.